quick background about us. The project name is Akropolis. We started about 18 months ago. The focus of the proposition was really on, and we are one of the earlier DeFi projects, focusing on building a layer of financial infrastructure that would enable people to save money, preserve value, long term, for a very specific use case. And that's namely the pensions deficit crisis, which is something that the US massively exposed to, the UK, most of Europe. So what we wanted to explore would be the alternatives to the current financial provision for the future, right? Short-term savings are kind of fairly easily understood. Long-term savings and incentives around that, and the structures around that are a kind of more complex beast. In the process of our research and customer research, because obviously crypto's main challenge is finding the elusive product market fit, we've come across a few quite fascinating findings, which the ecosystem isn't really widely aware of. And if you've been to Hugh's talk, Hugh from Nexus, Hugh's talk, you'll see that there's a lot of sort of convergence in how we think. Just very briefly, I'd love to give you just a little bit of kind of background around how we arrived at our current protocol design, our current model, and the lessons that we found in history that we're seeing the crypto ecosystem really kind of rediscovering second or third time over right now. Right? So really, we see the kind of a resurgence of interest in DAOs, but for anybody familiar with economic history, will know that actually, a DAO is mutual, is a cooperative. Of course, there is a difference in terms of, there being a legal wrapper, limited liability, but fundamentally, the problem of coordinating human endeavor is a very, very long-term problem. And what we've done here is we traced, I guess, the most prominent points on the sort of DAO timeline, if you would, right? From tribal and family units or chamas that are still existing and functioning in Africa, specifically in Kenya and Ghana, which basically are effectively community-based DAOs with a sole purpose of communal savings. So essentially, they are still existing prehistoric community banks, right? And what's fascinating is that they don't have a legal personality in law, so they actually are protected as an archetype. In law, what that actually effectively makes them the first and the longest DAO in existence. What's even more interesting is that the amount of value that they contain and pass through, right? Obviously, it's not in crypto, it's almost predominantly in cash. A lot of it still bypasses the banking system, and that's literally hundreds of millions of dollars. In Kenya, that's 47% of GDP, which is insane if you think about it. So if we look at the evolution of how people would typically coordinate their joint activity, we see evolution into guilds in the Middle Ages, then credit unions, mutuals, then obviously there's a move to shareholder model, and now we have almost a sort of backlash, obviously within a small ecosystem, and focus on community-driven models. What's interesting is that user or community-based models are kind of typically perceived as cutesy and small, but actually there are examples of long-term, viable, successful organizations, that effectively are functioning as, as DAOs. I can't comment on their approaches to governance, but user-owned, user-controlled organizations go back to, as far back as whatever, 72, with very, very substantial assets under management or, turnover figures. So that confirms that, I guess, a very common criticism of DAOs being, a fad or just a sort of temporary aberration or something for just a very small community of people can actually be quite viably countered by the fact that there are sustainable, existing, long-term, very successful user-owned models that we can learn from. Two many examples of how people, actually have coordinated activity, essentially, on a peer-to-peer level to meet their needs that either a state or institutions were failing to provide, right? So I've spoken briefly about chamas, just kind of, very quickly, a few statistics. So chamas are effectively, informal community-based banking groups and savings groups, right? In Africa as a continent, through chama or chama-like organizations, there's the amount of value that passes through is about 100 billion. And if you add on top remittances between the immigrant communities in the US, for example, that's 16 billion a year on top, right? So it's a massive market that most people aren't aware of. A lot of it is massively inefficient. But the underlying problem that they're solving is, frankly, the same problem that a lot of the DAOs are trying to address right now. And I think it's very important to look at, rather than trying to reinvent the wheel through a tech-only approach, to see how we've been solving this problem at a social, at a human level as well. This may be fairly interesting, but essentially, the main motivation for a chama or a small DAO to grow was actually very simple. If a member achieves their clearly stated goals in a group, then they stay. It's as simple as that, right? So mutual support in achieving a clearly articulated goal is actually the single most powerful explanatory factor for a DAO or a chama to sustain, let's say, and to evolve beyond a, let's say, 30, 40 people group. And the most successful examples that we studied actually evolved into proper community banks with banking licenses, where there were 25,000 members. And the most successful ones actually resulted in pretty interesting milestones. For instance, I had actually a cutout of the news, but I don't have it in this presentation. That's also in Kenya, where for the first time ever, women actually became landowners. So it was a cooperative of female farmers that's been saving through chama. So again, informally, no legal personality, simply a very established set of rules, which have been adhered to and validated literally by centuries. And in 4 years, they were able to acquire a plot of land and actually build the first student housing block in Kenya, right? So it was the first time for a co-op or a DAO to grow to that size, first time to enable land ownership, and the first time for a group of that size to achieve this in a very tangible target. So how does that feed into kind of how we think about the product and what we're building? Clearly, there is a divergence and, between DAOs and kind of traditional structures like cooperatives and mutuals. And I'm sure you know all of those details by now. What we are focusing on specifically is essentially enabling users to very quickly and easily set up what effectively is, at a very trivial level, a group-governed multi-signature wallet. There can be several of them. What you effectively do is we provide several governance modules. The group contributions get automatically converted into any counter-inflationary asset, right? And we're able to provide superior liquidity if you compare it to, for instance, a conventional legacy, let's say, pension fund, right? So what happens right now is that historically, the way people used to save or plan for the future is massively compromised because most pension funds are in massive financial trouble and it's not really being kind of widely spoken about. But kind of more and more instances of defaults or bankruptcies are coming up, and it's the next kind of big thing that's waiting to happen, right? So our approach was to look at how people used to do this historically, simply because fundamentally it's very tempting to think that tech can solve everything, but we're still human, we're still irrational. Social validation, human contact explains away so many more things that the tech will never explain. So we really modeled, let's say, the first two governance modules on exactly the lessons we drew from our customer research in Africa. And on the product side, I'm happy to share links with you guys, but I mean, everything's on our website and on our wiki. Essentially what the product, which will be on the mainnet towards December, and we're building an Ethereum implementation and a Polkadot implementation as well. What it will allow is essentially a geography agnostic, either savings fund, reserve fund, pension fund, whatever purpose you want to ascribe to it. It's particularly relevant to users in countries with high inflation rate. So through, obviously, the instruments available in DeFi space, we provide conversion to, whole range of assets. So, currently it's DAI and Compound, for example, just the easiest, kind of most relevant tools of both exiting into stablecoin and providing the yield, right? And in the next probably month and a half, we'll ship the module whereby it's kind of not dissimilar to a combination between how Nexus Mutual are thinking about providing liquidity to their members and how Homolog DAO have approached the rage quit functionality, right? So why is that useful? Simply because right now people are locked long term into savings pools, pensions pools, and there are at least two valid approaches that will enable superior liquidity. So if you're not happy with how that pool performs, you can take your funds out and move to another one, right? And you're not going to be restricted by geography or by whatever investable assets are available in your jurisdiction, which obviously is the main issue from, let's say, pension fund investing perspective right now, because in the event of economic crisis, which probably every analyst is expecting on the less than 5-year time frame, the biggest risk will be contagion risk, which means basically the domino collapse, of the banks, which we all experienced in 2007, and the funds actually being trapped, right? So this approach allows to sidestep these issues through alternative implementation, right? So obviously, it's an experimental approach. We're not saying that it's ready to be used by the masses, which are applicable to the whole of DeFi ecosystem. But it's a first step, and we're hoping that our approach to addressing the problem that is not going to go away anywhere is going to be helpful, sort of outside of the DeFi system as well. So as we go live, we'll be talking about it more, and we'll be more public. Thank you. If you have any questions, I'm happy to take them. Sure.
Yeah, sorry, a very basic question.
Could you
explain exactly? Yeah.
I think you need to.
Speak into the mic. Yeah, just a very basic question, but can you explain exactly what innovation you're bringing? I mean, with your product, because I think you covered the general area, but I didn't quite understand what innovation you're bringing, and if you can tie it back to what you were describing regarding the existing cooperatives. I mean, that's
sure.
That's
I mean, essentially, we go back to a kind of community model, right, where the users are the shareholders, or the users are owners rather, right? Because right now, let me take a step back. We're not actually claiming any innovation for one simple reason, is that there's very little new that's under the sun, right? What we looked at were what alternative, more economically resilient solutions are there that emerged, let's say, after the crisis of 2007, to prevent people from losing their savings, from being trapped in run-on banks, right? From being exposed to contagion risk and being frozen out of the credit market, right? If you look at the DeFi ecosystem as a parallel or alternative financial infrastructure that's emerging, that just kind of uses Ethereum to and other blockchains to through composability, through ability to quickly and efficiently do all the various integrations, simply show that in theory we can build a product or a network that provides the same services that a pension fund or a bank or social security structure would typically seek to provide, right? But let's say for some reason fails, right? Failures are multiple, right? So what we are working on right now, and as I said, we're not live yet. We'll be talking about it more in due course. Is an approach whereby if you already can be, let's say, your own bank. It's not a statement that is actually sellable to the masses, right? Because most people don't want the custody risk. But what we're working on is essentially a product that provides the same services that a pension fund or, depending on how you design it, or a social security fund, right, or reserve fund would provide, in such a way that doesn't make it dependent on the broader banking system, right? So it's not subject to contagion risk. Since it's a community-owned model, so users are co-owners, the bank run is impossible, because you don't engage in fractional reserve lending. It's as simple as that. So it's all about thinking about financial resilience and actually designing solutions for the next economic crisis, right? And how you could have a situation where you have no bank, you have no state, or the state is in default, right? Or the pension fund is in default or bankrupt. How do you get, let's say, emergency payouts, right? How do you get, how do you save funds long term in such a way that they're not eroded by inflation, right? How do you invest outside of your country if you're trapped in high inflation jurisdiction and you can't necessarily, and all you have is a smartphone, right? So these are the questions that we are working on addressing. The first iteration is basically is group savings, right? That's modeled on exactly the same approach that's currently active and has been active in Africa for actually the last 6-7 centuries, right? Whereby people coordinate using smartphones, the pool funds. And the funds are, let's say, attract an interest rate through compound, through through the off-ramp facility. You can acquire assets, be it crypto assets or in due course, when the ecosystem is ready, real-world assets. Right? So it's all about self-sufficiency and not depending on a banking system or a state. People have been doing it for a long time. We're just now just using the tech to make things cheaper, faster, hopefully more reliable, and more scalable. That's it.
Anyone else have a
No?
question? Sorry, how does that decision making work? Sorry.
Sure.
Like, what's the governance model, and how does
Sure.
decision making work within the protocol?
So if we look at how things were done, let's say, and have been done inside Chamas, it's actually it's simple supermajority. So, and this is the way things were done, as I said, for about 6-7 centuries. So assuming you have a reasonably small group, a supermajority vote is actually the simplest, most robust approach that's been proven to work so far. I'm not saying in DeFi, I'm saying out in the wild, right? But we're going to be shipping different governance modules, right? Because if you cater to a crypto native ecosystem, right, we have a whole kind of menu, right, of governance modules that some are deeply experimental, some we're kind of getting more and more comfortable with. But historically, people used to and still do it with supermajority vote, typically 70% approval. Right. Yes?
Just how do you deal with proxy? I think I've got a very loud voice here.
Oh, the mic's for recordings, right?
Oh, the mic's. Thanks. How do you deal with proxy voting? Because, the problem is that you could actually have overriding with proxy voting. Mm. And I was just wondering, how do you deal with that?
Sure. Again, so historically, the groups will all have a strong social element to it. So, a member or members typically gather physically in one place, right? But if we're talking about entirely decentralized digital setup, if you'd like to assign your vote, right? Yeah, if you'd like to assign your vote, you just delegate it to another member. So your reputation and their reputation get taken into account. But you simply delegate a vote, yeah.
Okay, so what stops somebody gathering the votes to be overruled? Because that's what happens
Sure.
in the real financial world right now. You know, you go into a
Oh, these are-
shareholders meeting and you have a whole bunch of guys who've decided on the outcome ahead of time. And
Yeah, so these are historic, okay, so these are typically, so the target for this is typically informal economy, right? So the governance modules, or rather governance models for small groups are different than governance models for large groups by definition. I mean, I can quote down by number to you, but I'm sure you're all familiar with this. So for small groups, a typical approach is that it's invite only, and every new member gets effectively underwritten by existing 2 members. Okay. So again, this is the way it's functioned historically, and this is what we wanted to incorporate simply because if it worked for such a long time in a number of very unstable economies, very unstable circumstances, it's showing a degree of robustness and resilience that shouldn't be discounted, right? In large groups, right? The most reliable way to address it is obviously linking it to reputation and staking. So that's the most common approach so far. But it's theoretical, right? Because it hasn't been tested in a very large setting. Yeah. Cool.
Anyone else with questions?
Oh, I think that's it. Thank you.
Thank you.
Thanks for your time, guys.